I think I'm a little bit delinquent on posting, so I'll get on that. And let's go ahead and first finish up. I can close this now and finish up. We had module 8 still from chapter 3, and then we'll jump into chapter 4. Okay. And what we're talking about here in module 8 is the requirements for impairment. So some years back, FASB looked and said, well, look, we carry our intangible assets, our fixed assets, we carry them at historical cost. However, what happens? There is potential, and often the case, that an asset will lose some value over time beyond whatever its cost is being carried on, at amortized cost, at depreciated cost. And so if it falls below that amortized cost, that depreciated cost, then we have to write it down to that lower impaired value. Now, when we look at this, we're looking at impairment of intangible assets other than goodwill, but it would also work the same for fixed assets. I can't tell you why the book has chosen to give us 2 separate discussions, one for intangible assets and one for fixed assets here. We're going to look at it just for the first discussion of it. We're not going to repeat again the same thing for fixed assets. Just know that goodwill has a different approach. And when we look at impairment for goodwill, we'll look at that in a later chapter. I think we'll look at that in chapter 4 a little bit later, not tonight, but on another night. Okay, so impairment of both intangible assets. Remember, intangible assets are things like patents, copyrights, that sort of thing. And then, of course, you know that fixed assets are property, plant, and equipment. Okay, so what we do when we're looking at the impairment for both fixed assets and intangible assets with a finite life, we use a 2-step approach. Okay, and what we do is we look at the carrying amount of the asset and compare that with undiscounted cash flows. So we look at any cash flows that are going to be generated from the use of that asset, add those up, undiscounted. Let's say we determine we're going to make $1 a year for 1 million years. Then we'll say, hey, this asset's going to generate $1 million of cash flows, undiscounted. You compare that to the carrying amount of the asset. Now, if the future undiscounted cash flows are more than that carrying amount, we stop. We do not have to do any impairment calculation. If those undiscounted cash flows are less than the carrying amount of the cash, than the carrying amount of the asset, then at that point we say, hey, we're not going to recover the carrying amount. Now we have to go ahead and calculate the impairment. And the way to calculate the impairment is to go ahead and discount those same cash flows to present value, discounted to present value, compare that to the carrying amount, and that is going to be the amount of loss. Okay, so a useful cash flow pass key here is to look and notice that they tell us to determine if the asset is impairment, use undiscounted cash flows. To calculate the amount of impairment, use fair value, and you can write in here, AKA discounted cash flows. So determine if there is impairment, do not discount the cash flows. If you determine that there is impairment, then discount the cash flows to actually calculate the amount of the impairment. Okay, so let's just go ahead and take a look at where we will report the impairment loss, and then we're going to have a numerical example that is very useful, I think, in helping to illustrate what we just flashcarded up there. If the loss is related to a continuing operation, then the impairment loss will be part of our income from continuing operations. If the impairment loss, and remember when we talked about impairment, we had loss from the operation of the asset, the impairment of the asset and disposal gain or loss. So that impairment would be part of the loss that we would report in the discontinued operations of the income statement. And of course, we would report that net of tax. Okay. Now, Notice that restoration of previously recognized impairment losses is prohibited unless the asset is held for disposal. If the asset is held for disposal, you can write it back up, but not in excess of any previously recognized losses. So you take a look, and let's just look at the calculation, okay? And basically, what you will do is you will look at the undiscounted future cash flows. You will compare that to the net carrying amount of the asset. If the net carrying amount of the asset is more than the undiscounted cash flows, you have no impairment. You simply stop right there. You don't have to do anything further. If it turns out that the undiscounted cash flows are less than the carrying amount of the asset, now you have impairment. If the asset is held for use, okay, and let's go ahead and flashcard what we will do. We will take the fair value of that asset, and the fair value of that asset is really now using what? Discounted cash flows. So you'll take that same cash flows that were undiscounted up here, and now you'll discount them. That's the fair value. You will then compare that to the net carrying amount. That difference is impairment loss. You write the asset down. You amortize or depreciate the new costs, right? You've written it down to a lower amount. Now you're going to amortize, depreciate that over the remaining useful life of that asset, and restoration is not permitted. If we're sitting here and the asset is held for disposal, then what? The fair value again will be what? The discounted cash flows. The difference between that and the carrying amount is going to be the impairment loss. Then to calculate the total impairment loss, you have to figure out any cost of disposal. We're going to have to pay a junk dealer to come and haul this thing off or something. That's part of the total impairment loss. The rules here are that you do what? You write the asset down. You no longer depreciate, amortize that asset because what? You're not going to be using it anymore. So there is no need to depreciate any future economic benefit. Restoration is permitted, but, and maybe by the word restoration, that is self-evident, but I want you to write it in, not in excess of previously recognized losses. So you're capped at any amount that you had written it down. You can't write it up above its original net carrying amount. But I'm just going to put that in FASB speak, not in excess of any previously recognized losses. And flashcard those rules. Okay. Now, before we address questions here, let's just look at this example, and then we'll see and open up if you have any questions. Okay. So what happens? We have an asset with a carrying amount of $900,000. Net future cash flows are $1 million. Okay, these are what? These are undiscounted cash flows. Okay, and if the net carrying amount of the asset is $900,000, the future undiscounted cash flows are more. There's no impairment loss. We simply stop. We don't have to do anything else. That's it. There's no impairment loss. Now, looking at this fact pattern, and this time they still tell us that the net undiscounted cash flows are $1 million, but now they tell us that the assets carrying value is 1.2 million. So what happens? We look, and since we're not going to recover those cash flows, right? The net carrying amount is the undiscounted cash flows. Again, undiscounted here are what? Are 1 million. The carrying value of the asset is 1.2. Because that number is negative, we have impairment. Now what are we going to do? Now we're going to go ahead and we're going to bring down the present value. Okay, so now we have what? We take those same cash flows, but now they are discounted cash flows. Okay, and I'm going to do the asset is held for use first. Okay, we compare that to what? The carrying amount of the asset, and we have impairment of 500,000. So we're going to credit the asset account to write it down. We'll debit the impairment loss. We will now amortize that 700,000 or depreciate the 700,000. If the asset had a 10-year life, we would continue to take 70,000 depreciation per year if that was the remaining useful life. We can't write it back up. Restoration is not permitted. Now, if the asset is held for disposal, again, the undiscounted cash flow is 700,000. The carrying amount is 1.2. So we still have that same 500,000. But now the problem told us, hey, there was some cost of disposal of 100,000. So that deepens the impairment loss. So now you'll debit impairment loss 600,000. You'll credit the asset 600,000. You no longer depreciate, amortize that asset because you're getting rid of it. You can restore it, but you can't write it up past that original 1.2 million. Question? Okay, again, I'm not sure, guys. I cannot tell you why they had to repeat themselves for property, plant, equipment. The only thing that changes, I think, is they changed the word from amortize to depreciate, but there was really no difference between the two. So I'm not going to repeat all that. Okay, question? Okay, let's go ahead then and let's jump ourselves into chapter 4. I'm going to close this off. There's no questions. And I'm going to take a quick, it's kind of a little annoying, but why don't we take a quick 5-minute break? I don't think there's really a material difference between 4.1 and 4.2. But if you desire to download the 4.2 book that is on e-learning now, I did go ahead and load that earlier today. So you could go ahead and grab that off of e-learning right now. How's my e-learning? Okay. Somehow I always manage to close e-learning before class starts. Now I have it open at the beginning of class. I figure out a way to close it once I manage to close it and it's not open when I actually start class. But I just want to show you a couple things there on e-learning. Okay, so what I'm pointing out here is when you look at chapter 4, you do have the 4.2 version there. If you want to download that now, you can. Again, 4.1, if you have that in front of you, I don't think you're going to have a problem with the material difference there. Also, you may want to download this little example that I'm going to be going through a little bit later this evening. Okay, so I'll give you, let's just say 6:35, guys. I'll give you some time to download that, and then we'll come back and
Professor,
chapter 4. Yes, sir.
Professor. Hello.
Yes.
Question. I don't see chapter 4 PDF download. I see chapter 5 PDF.
Well, if you go under chapter 4, under chapter 4, you should see Summer 2022 F4 version 4.2, chapter 4 PDF. You don't see that?
My chapter 4. I mean, it's a.
Is anyone else experiencing the same problem?
I think you might need to finish the survey in order to.
Okay.
Like, yeah.
Okay. Thank you. It's okay.
Sure.
Okay. Thank you. Okay, good. So I will give you some time to do what you have to do to be able to access that. I don't know how much value there is in downloading that, because again, if you've got 4.1 in front of you, I don't think there's a difference, but you can make that decision. Okay, guys, any question? Okay, we'll take a short pause here and then we'll resume with chapter 4. Resume the recording here. And we can jump into chapter 4. Okay, now when we take a look at the topics for chapter 4, we're going to start out talking about the accounting for debt securities. Okay, and we're considering those financial instruments, and we're going to see that with debt securities, we have three different categories that we can put those in: either trading, available for sale, or held to maturity. And we're going to see that depending on what category will primarily affect how we report unrealized holding gains and losses, either not reporting them at all, or putting them on the income statement, or considering them part of comprehensive income. When we talk about accounting for equity security, essentially stock investments, we're going to see that we are going to use the fair value through net income method for most cases, and we're going to be running those unrealized holding gains through gains and losses through the income statement, unless we hold enough of the stock to exert significant influence over the entity. Then we will use the equity method. So when you look at that first section there, we're going to see financial instruments. And when we talk about using debt securities, okay, or if we're talking about fair value through net income through for stocks, that tends to be about 5 points on the exam. Okay, when we get into the equity method, that tends to be about 5 points on the exam. So we're going to be looking at that here in the early part of the class. Now, today. Now, we won't get through all of this today. We're going to basically stop at module 2. I'm going to ask you to look at some basic background stuff on your own that are given in module 3. And then when we come back next time, that's where we're going to have this big area. And this is the reason I don't want to try to tackle this tonight, because I want to be very focused here. Let me just write it over here. This blue on blue didn't work. And let me change it to red. This is going to be, I changed it to red. This is going to, okay. This is a 10-point area on the exam, okay, not 110 points, 10-point area on the exam. You are either going to be asked to perform a full consolidation as part of a task-based simulation, and or you will receive a large number of multiple choice questions asking about consolidation. So I'm treating that all as one big area, 10 points. We need to focus on that, concentrate on that for next time, so that we're just looking at that as a whole entire module, or almost, even though they've broken it up into different modules, I want to deal with all that in one sitting. And then goodwill, and they'll talk about the impairment for goodwill in there. As I had mentioned a little bit earlier, goodwill is treated differently than other intangible assets. And so we'll look at the goodwill, including the impairment, when we get to that last module. That's about 5 points. Okay, so we're going to focus up here tonight. I'm going to ask you to take some time to look at the sort of little intro video about this that they have available for you on your own. And then next time we get into modules 4 through 8 as we wrap up chapter 4. Okay, all right, good. So let's just come over and let's take a look at this first module. And just to make sure that we understand, when we're talking about financial assets, financial instruments, guys, even though they list a bunch of them off here, we're really talking about stocks and bonds. Okay, now we're not talking about the company that's issuing the stock, issuing the bond. We'll get into those in later chapters. We're talking about the entity that is what? Acquiring stocks and bonds of other companies and holding those as an investment. Okay, so you can see they call out stocks, okay, evidence of ownership, stocks, and then they also talk about, conveyance, contract to convey one thing to another party. They talk about bond investments. So we're really talking about stocks and bonds here. Okay, now, even though we're going to be looking at how you can account for transactions, depending if they're a debt security, you could have a debt security that you have the positive intent and ability to hold to maturity. Those go into the held to maturity category, and you're not required to even calculate an unrealized holding gain and loss if the security is sitting there and it's in the held to available for sale category. If you do have unrealized holding gains and losses, those are part of comprehensive income, right? And it only goes into net income if it's a trading security. That's for our bonds. For our stocks, we treat those as trading security equivalent. For bonds, in which, for debt securities in which unrealized holding gains and losses go through the income statement, unless we hold enough of the stock to exert significant influence, then we could use the equity method, okay? But what this is telling you right here is you are allowed to use treat everything like a trading security, or treat everything like a stock that you don't own enough to exert significant influence, and they call that the fair value option, okay? So on a specified election date, entities may choose to measure at fair value eligible instruments that are not typically measured at fair value. Under the fair value option, unrealized holding gains and losses are reported in earnings. They're reported on the income statement, and this option is not revocable once you decide. So even though we're going to be talking about, available for sale securities for bonds, the amortized cost for bonds, the held to maturity category, we're going to talk about the equity method for certain stocks where you exert significant influence. They tell you could opt out of that and just use the fair value option, okay? Now, it is worthwhile to look at this section down here, and we say entities may elect the fair value option for recognized financial assets and financial liabilities. For example, an entity can choose to measure at fair value a debt instrument that would otherwise be classified as available for sale, or frankly held to maturity, with unrealized holding gains reported in earnings rather than in OCI. An entity could choose to measure at fair value a equity instrument accounted for under the equity method. So these are examples. But there are certain types of items that they will not allow us to carry at the fair value option. And so let's flashcard the exception to the rule up here, the option up here. And financial instruments not eligible for the fair value option include investments in subsidiaries that the entity is required to consolidate. Let's stop there for a second. Once your ownership interest exceeds 50%, 50.0000001%, you are required to consolidate that entity with your financial reports. And that's what we're going to talk about in Module 4 when we get to it. And so you can't opt out of that requirement. Once you exceed the 50%, you do have to consolidate. Pension benefits, certain other things here that you can see listed, guys. I'm not going to read all of these, but flashcard all of these as the exception to that general rule. Question?
Yes. What is OCI?
Other comprehensive income. We talked about that in chapter 1.
All right. Thank you.
Okay. OCI is other comprehensive income. Remember, we had the mnemonic puffer. So we had pension accounted for pensions. The U was unrealized holding gains and losses and available for sale securities. And I went through a kind of detailed example at that time and how that would be reported as part of other comprehensive income. So remember, we take our net income and then we adjust the net income for different things like the unrealized holding gains and losses on available for sale securities to calculate comprehensive income. So our other comprehensive income consists of the pension, the unrealized, the foreign currency translation valuation, the effective portion of cash flow hedge, I believe was the other one. So it was puffy, I think. And for those, we make adjustments to net income to calculate comprehensive income. So comprehensive income is our net income plus our other comprehensive income, the OCI items gives us comprehensive income. We talked about that in chapter 1. Okay, all right, good. Now we come over and we talk about the discussion here now, looking at debt securities. We're going to look at debt securities, which are bond investments, and then we'll turn our attention to equity securities, which are essentially stocks. Okay, so even though they have a bunch of different, things that are listed here, let's just talk about corporate bonds, or let's just visualize bonds as we go through this. Okay, now we're going to have one of three categories in which we will categorize our bond investments. Okay, our debt security investments. One is trading securities. And trading securities are debt securities that are bought and held principally for the purpose of selling in the near term. Okay. Now, trading securities generally reflect active and frequent buying and selling with the objective of generating profits on short-term differences in the price. Let's go ahead and highlight in a different color flashcard. Debt securities classified as trading securities are generally reported as current assets, although they can be recorded in non-current if appropriate. So lack of any other effective information that would tell us to treat it as non-current, we should treat that as a current asset when we make that investment in a trading security. Now you come over and let's just look at held to maturity securities, and we'll come back to available for sale. Okay. And investments in debt securities are classified as held to maturity only if the corporation has a positive intent and ability to hold these securities to the maturity. If the intent is to hold the security for an indefinite period of time, but not necessary to maturity, they would put that security in available for sale, which we're going to look at here in a second. If a security can be paid or otherwise settled in a manner that the holder may not recover substantially all, then we can't use the held to maturity security category. So flashcard that, and then flashcard that securities classified as held to maturity are reported as current or non-current depending on their time to maturity, and you can flashcard that. Okay, so far all we've talked about is where to classify these really on the balance sheet. And for a trading, it's typically current. For a held to maturity, it's current or non-current based on the time to maturity. If it's going to mature in the next year, it would be a concurrent asset. If it's going to mature beyond the current year, it would likely be non-current. Okay. Now coming back up, available for sale securities, and they basically tell us, and the reason I wanted to go to held to maturity first is say, if you don't put it in trading and you don't put it in held to maturity, then it's available for sale. And debt instruments, say investment in bonds classified as available for sale securities, are reported as either a current asset or non-current, depending on the intent of the corporation. And guys, I think I've asked you to flashcard these here each time, and I do want you to flashcard it, but actually we have a table coming up that will not make it necessary for you to write up a flashcard for each one of these, because that table will serve as one flashcard for all of these. But the takeaway from this discussion here is, how do you report on the balance sheet, either current or non-current? And in the case of the trading, it's current generally. In the case of the held to maturity, it depends on how long to maturity. And if it, when we're dealing with available for sale, it really depends on the intent of the corporation. If they probably plan to sell that within the next year, it's going to be current. Beyond the next year, it's going to be non-current. And I reckon time to maturity could start to play in here, although then it would say, you could argue, well, now it's a held to maturity security. You didn't know for all those years, and now towards the end, you've decided to hold it to maturity, then it would be a held to maturity security. And we'll talk about what happens when you reclass out of one category to another here in a couple seconds. Okay, now for the valuation, okay, and we are going to see that the securities, debt securities, are reported at fair value if they are considered unrealized, if they're considered trading securities, if they're considered available for sale securities. Okay, so those that are categorized as trading and available for sale are reported at fair value. Okay, so what will happen? We will look at those securities in those two categories, trading and available for sale. If it's trading, we will literally debit unrealized loss on trading securities, and it is recognized in net income. It is going to go where? It goes to the income statement. Okay, it's going to be part of our, in this case, loss on it's probably going to be considered a non-operating item. It'll be part of our net income from continuing operations, right? If it is an unrealized gain or loss on available for sale security, then that's going to be part of the comprehensive income. So now that becomes what? PUFE. That's the U in Puffy that we talked about in chapter 4. And so that's going to be part of my other comprehensive income. Okay, and you can see that you will literally, you will literally debit the loss that's reported as part of OCI. And of course you will, and they tell you to credit the valuation account for the fair value adjustment because you're writing that security down. The security is an asset, so you're going to credit the fair value adjustment. That's going to reduce the carrying amount of that security. You can almost think of it, guys, if the valuation account gets confusing for you, as a credit directly to the asset account, right? That brings it down to that lower fair value. Now, if it is when you finally sell the security, okay, when you finally sell the security, then you will go ahead and you will take the gain or loss and you will take that into net income, and the amounts that goes into net income is the difference between whatever you paid for that and whatever you sold it for. Okay, so you can just go ahead and flashcard that. Now they talk about unrealized gains and losses, and they show us the loss situation. Of course, if it was a gain, we'd be doing what? We'd be crediting an unrealized gain and debiting the security account, right? And depending on whether it was available for sale or trading, if it's a trading, that would report on the income statement. If it's a loss, that would be reported as part of my other comprehensive income. Now, if we are dealing with held to maturity security, then we do not have to come up with any unrealized holding gains and losses. We will simply carry that at amortized cost. Amortized cost is the face plus any unamortized premium, or can't be both, face on the same security minus any unamortized discount. That's what they mean by amortized cost. Okay, and they're not recognized in the financial statements. We don't have to take unrealized gains and losses, even though the security may be maybe have declined in market value. We don't have to take losses. Now, there are situations where if there's a credit loss on a bond security, then we would have to take that credit loss. But the general rule for the held to maturity is that it not be carried at that we not have to recognize unrealized holding gains and losses. Okay, so let's just take a look right here and let's just flashcard this table. And you may have a flashcard already. Remember, guys, you do have your Becker flashcards. And so you may already have a card that does this, but if not, you can copy this card instead of having to make those individual flashcards that I was indicating before. You have the category on the balance sheet, current or non-current, although trading is generally current, right? Available for sale. Held to maturity can be current or non-current for the available for sale, depending on the intent of the company. For the held to maturity, depending on the time to maturity, right? And for trading, unless there's some unusual circumstances articulated in question, it would be typically would be current. For our we reported on the balance sheet at fair value for trading and available for sale, amortized cost for held to maturity. Unrealized holding gains and losses go to the income statement for trading. They're part of other comprehensive income for our available for sale. And if it's held to maturity, we don't have to calculate those. Okay. Where do we report these unrealized holding gains and losses on the statement of cash flow? Okay. And you can see here that when we're dealing with trading debt securities, they're classified in operating or investing based on the nature of the purpose for which the security was acquired. If trading debt securities are classified as non-current on the balance sheet, then that trading debt transaction will be reported as investing cash flows. If it is current, then it will go into the operating categories. So include on your flashcard that treatment for the different reasons, current or non-current, that you would include an unrealized holding gain or loss in the either operating section or investing section on the statement of cash flows. This is the problem with the indirect method of the statement of cash flows, because remember, under the indirect method, you start with net income and then you reconcile the cash provided by operations. Well, if you take an unrealized loss on a trading security, because you're carrying that as a current asset, you would have to take that unrealized loss and do what? Add it back to net income to get to cash provided by operations, right? Because it reduces your net income. Meanwhile, it didn't use any cash. But what's annoying about it is, why are we reporting unrealized holding gains and losses on investments in the operating section of the statement of cash flows? Meanwhile, unless we're a bank or a brokerage house or something like that, the unrealized holding gains and losses on investments would typically be treated as non-operating on the income statement. So I'm of the opinion that FASB should abolish the indirect method because it has certain theoretical problems with it. But flashcard, how to treat that on the statement of cash flows here. Okay, question. Okay, good. Reclassification. Okay, what happens if we take a security out of one category and into another category? Okay, so if it had been a trading security and we take it to any other category, in other words, available for sale or held to maturity, don't do anything. You've already taken the loss into net income. You don't have to do anything at that point. No adjustment of your set is necessary. Okay. Now, if you are sitting here and let me catch myself up, guys, because I know I want you to flashcard this. Yeah, they have another table coming up, so don't worry. Okay. From trading, don't do anything. Just move it into the category, the new category, and then treat it using the new method going forward, right? If it goes to trading, so let's say it comes out of available for sale and goes into to trading, well, then what's going to happen? Any losses shall be recognized in earnings immediately. So once you go out of any category to trading, think about it. Unrealized holding gains and losses maybe are contained in other comprehensive income. If it's an available for sale, or if it's held to maturity, you haven't even been taking any unrealized holding gains and losses. Well, they tell you, since you put it in trading, you are to immediately take all the losses that it maybe had accrued over some time and take those to the income statement. Okay. If it goes from held to maturity to available for sale, now unrealized holding gains and losses that you hadn't been taken before need to go where? Need to be immediately taken into comprehensive income. Okay. And then if it goes from available to sale to held to maturity, what happens? Well, let's think about this. During this time, you would have been doing what? You would have been taking unrealized holding gains and including them in OCI, right? Okay, so what they're going to do is allow you to take those out of OCI, the accumulated OCI, but you're going to have to do that over the remaining maturity of that security. Okay, so the unrealized holding gain or loss at the transfer date is already reported on the comprehensive income. The unrealized holding gain or loss shall be amortized over the remaining life of the security as an adjustment to yield in a manner consistent with the amortization of a premium or discount. Okay, now when you look at that, guys, and I'm going to come back up and remind you to flashcard that table in a second. But when you look at this one, it's kind of like, what? Okay, so let's just go ahead and let's use a numeric example, because that doesn't exactly something that you just automatically visualize. Okay, so say, you can just write this down, guys. Say company has available for sale security purchased at par of $100. Okay, so when they purchased that security, they credited cash, of course, and they would have done what? This is my available for sale security. They would have debited available for sale security for 100, right? Because they purchased it. And they just carried it there at amortized cost excuse me, not amortized cost, but because it was an available for sale security, let's say over some time that they held the security, say it's a 10-year maturity. And for the first 5 years, it gains in value. Okay, and it gains $10 in value. So what would they do? They would debit the available for sale security. They would credit what? They would credit unrealized gain. We close unrealized gain to what? Accumulated other comprehensive income. Remember, we said that's like the retained earnings of the comprehensive income. Okay, so we've got the security now at 110. We've got the accumulated other comprehensive income sitting there at 10. Okay, and then in year 5, change the color on this. Year 5, they move it to held to maturity. Well, what's happening? They have unrealized gains sitting in accumulated other comprehensive income of what? Of $10, don't they? Okay, so they would take that $10, they would divide it by what? Now the 5 years remaining. And so that means they're going to amortize what? $2 per year. Okay, so what they would do is they would go ahead and now they would go ahead and each year they would debit the other comprehensive income, unrealized gain on the security. Okay, where do I want to write that? I guess I got to write it over here because I don't have anywhere else to write it. Okay, so we would go ahead and debit other comprehensive income for what? $2, and credit the security for $2 each year. Year 5, we do this. Year 6, well, what's 5 years? So year 6, 7, 8, 9, 10, right? For the 5 years. Okay, so I guess it'd be year 6 they move it. Not year 5, but year 6. Okay, so year 6, 7, 8, 9, 10, they would do this. And if you think about it, guys, what would happen? Each year they do that, of course, OCI gets closed to what? OCI would get closed to accumulated other comprehensive income. So they would do what? $2, $2, $2, $2, $2, 1, 2, 3, 4, 5, and $2, $2, $2. I don't know if it's necessary for me to write it 5 times for you to get the point, but they would write the security down as though they're amortizing a premium, right? And they're taking that out of accumulated other comprehensive income. Okay, so that's what that means. I don't know that the exam gets all off into that, but just in case you got something that you were looking at, that's what would be going on there. Question? Serena, do you have a question? I thought I saw you raise your hand. No? Okay. Okay, good. So go ahead and flashcard this table though, guys. Flashcard, because that sort of gives you, and if you need to, you know, look back at this example here to help you with that, that's all that means. But it's pretty easy stuff, right? Except that last one is a little bit funky. Okay. Okay, good. Now, as you're going along and you have what? You have investment income, the interest income from the investment in debt securities is reported on the income statement. I have to be honest with you guys. I don't know why they left out available held to maturity security, because there could still be interest on that thing. I mean, that's the reason you made the investment on a held to maturity security, so that you're earning interest on that. So I don't know why they just called out trading or available for sale. It all hits the income statement. Any interest that you get on that is an income statement item, unless I'm missing something. I don't know what they're talking about. Okay, so just remember that the income part of a debt security goes to the interest part of the debt security goes to the I guess the reason they left it out is because they're going to give us a separate discussion as to how to calculate the interest income, and they put that in a pass key, and I'm like, what the F are they doing here? This is silly. I mean, this is nonsense. Interest on debt securities, the interest is an income item, period. How you do that exactly, yes, we'll talk about that process a little bit more in F5. Okay, okay, good. Now you come over and what if there is an impairment of a debt security? Okay, and this gets a little bit tricky, right? So far, stuff's pretty straightforward. This gets a little bit tricky, okay? And that if it is determined that all amounts, principal and interest, will not be collected on the debt investment reported at amortized cost, the investment should be reported at the present value of the principal and interest that it's expected to be collected. There will be a credit loss for the difference between the present value and the amortized cost that you're carrying it at. So you have this investment, you're expecting to collect on this, and then all of a sudden the company that you bought the bond from is starting to have some problems, right? Okay, and they're not going to be able to pay you, so they're going to make you calculate an impairment on that. Okay, now how we will report that will depend to a certain extent on, well, what is the fair value of the security when we start talking about being in the available for sale category. Then we're going to have a little bit of a different treatment. But let's first look at the held to maturity treatment. And on January 2nd, we purchased $500,000 4-year bond at par with an interest rate of 4.52. The classified the investment as held to maturity. At the end of year 3, we received the full interest payment, but determined that it would only collect $11,500 interest for the remaining life, along with the face amount at maturity of $500,000. That doesn't sound very realistic to me, but okay. So they're not making the interest payments, but we think in 5 years they're going to be able to pay us the whole $500,000. Hardy, har. Okay, but whatever. I'm not going to argue with the question, okay, with the fact pattern. So what happens? We come up and they tell us that the present value of $1, we'll apply that to the principal, is at 4.25% interest, which was the interest on the bond. Is 0.88265. Present value of an ordinary annuity is 2.76198. We'll apply the 0.88262 to the principal, the 2.76198 to what? to what we think we're going to be collecting for the next 5 years on this, right? Okay, so what should we do at the end of year 3? I'm not 5 years, but 3 years. What should we do at the end of year 3 on this bond? And notice that they go ahead and they take those interest payments, okay, and they say, well, we're going to collect on a present value basis, $31,763, and the principal on a present value basis is going to be $44,130. That's the total present value of that. We're currently carrying that thing at what? $500,000. So we have to report a credit loss on the impairment, and we set up an allowance, a contra asset against that investment. And that credit loss is going to be reported on the income statement, because we're not going to collect the full present value of that bond. Okay, or the full carrying value, excuse me, that is the present value. We're not going to collect the full fair value of that bond. Again, I find a little unrealistic that the company thinks, well, they'll get the 500,000, but the company can't even pay the principal in 3 years. Things are going to get better, I guess. I don't know. But, you know, if they thought they were going to collect something less than 500,000, then they'd use that less than 500,000 to calculate the present value of the principal. Okay, I guess stuff like that happens. I find it a little unlikely, but whatever, I don't know. Okay, now, if it is available for sale, okay, it's accounted for differently because the investor has the option to sell the available for sale security if the loss on the sale will be less than the expected credit loss. So you figure out the credit loss and you say, well, wait a minute, if I wait, I'm going to suffer this credit loss. Screw it, I'm going to sell it now. And so you're going to have to look at the circumstances to see, in some cases, you could go ahead and just take an unrealized gain for that and you're done. If the carrying amount is more, if it starts to become less, then what? Then you're going to have to sit there and partition that loss into unrealized holding gain and loss in OCI, and then and then eventually you may have to go ahead and report that credit loss. Okay, so let's just take a look, guys. And I know that sounds a little bit confusing, but you can see here what I want you to flashcard. As a result, the credit loss reported in net income on available for sale securities is limited to the amount by which the fair value is below amortized cost. Any additional loss is going to be reported as an unrealizable loss in other comprehensive income. So I think I want you to flashcard that, but I think the example is a pretty good one. So let's just look at that. Okay. So same fact pattern, that securities being held at 500,000, and they determine, hey, they're not going to be able to pay us. And then they start calling out all the interest. They have that present value that we calculated before, but now they give us different scenarios. Well, what if the fair value is 510? What if the fair value is 480? What if the fair value is 450? Okay, so you take a look, and under the 3 scenarios, if the fair value is 510, okay, notice we don't have any credit loss because we could sell that security immediately and gain 10,000, couldn't we? So they go ahead and they just allow us to compare the fair value to the amortized cost, and we're carrying that as, and we'll take the gain on that. Okay, and you can just go ahead and they show you the journal entry down there. I don't know that the journal entry is that important. Okay, then what? If the amortized cost is 500 and what? And the fair value is 480, then what? Then we have this expected credit loss of 26,927, guys, which came from the previous example where we discounted those cash flows. Okay, but when you look, since the expected credit loss is more than the than the difference between the fair value and the amortized cost, we're limited to reporting a credit loss of just 20,000, because again, we could sell at that point for 480 and our loss would be stopped at 20,000, right? Okay, if the last scenario, we have what? We have this difference of what? Of 50,000. Well, now we'll do what? Now we'll report the entire 26 297 as a 927, excuse me, as the credit loss, just like we did when it was a held to maturity security. And then we have to do what? We have to take the difference between the 26,000, the 50,000 and the 26,927. That additional amount will get reported as OCI. Question? Yeah, it's a little bit funky, right? But that's how they want us to do it. So it's all about what? It's all about deciding how to partition that into what? Whether it's OCI, whether it is what? Whether it is credit loss and OCI, right? Which is what happened here for an available for sale security. Okay, good. Now, when you come down and you ultimately sell the security, okay, when you sell the security, okay, what happens? The realized gain or loss when a trading debt security is sold is the difference between the adjusted original cost plus or minus any unrealized gains and losses, and the selling price. Okay, so you would simply do what? Let's say you bought the security for 100, and then the security had what? When you bought the security, let's see. Let's just do it this way: trading security. And when you bought the security, you paid 100 for it. Okay, let's say that the security has had gains of 10 that you've taken. So you've debited the security, you've credited net income all those years for the 10, you know, you've taken those into income, and then you sell the security for 130. Let's do that. So when you sell it for 130, of course, you would do what? You would debit the cash. You would credit the trading security for what? For 110. And you would take the realized gain, and the realized gain is going to be this 20, okay, which is the difference between what it was being carried for and what you ultimately sold it for in the year of sale, which is this 130. Okay. Okay, good. Now you come over, and available for sale security is a little bit different. Okay, now when you look at the available for sale security, okay, and they tell us the realized gain or loss that is that when available for sale security is sold is the difference between the selling price and the original cost of the security. Flashcard that any unrealized gains or losses and accumulated other comprehensive income must be reversed at the time the security is sold. Flashcard that. Now, let's go ahead and let's just do a little example here. Okay, so let's say I buy an available for sale security for $100. So I debit the available for sale security, I credit the cash when I buy that security. Okay, now let's say that I look and the security has a value of $10. Okay, an increase in fair value of $10. So I would take what? I would take my other comprehensive income and I would report what? Gains of $10 there, wouldn't I? So in my accumulated OCI, I'd have $10 sitting there because I've written that security up year over year, right? I don't know, maybe it happens all in 1 year, whatever. It doesn't really matter how long it takes to get in there, okay? Then I go ahead and I sell the security. And I sell the security, and I'm going to just go ahead and put the numbers up here in this journal entry. I sell the security for $115 cash. Okay. Now, what happens? the available for sale security is going to be credited for what? For 110. That'll get rid of it, right? It's off the books now because I sold it. The unrealized gain on available for sale security, I'm going to debit that for what? I'm going to debit that for 10, and then that ultimately gets what? That account gets closed to the accumulated other comprehensive income, because the other accumulated other comprehensive income is like the retained earnings of other comprehensive income, isn't it? Okay, so I'm going to go ahead and I'm going to close that out. I'll credit the unrealized gain. I'll debit accumulated OCI. So that closes that out to 0. And now I'm going to what? Credit realized gain for 15. And that is going to be reported on the income statement, right? Thus, that statement that I had you flashcard up there is correct. The amount that gets reported as a realized gain is the difference between what? The original cost of the security and what you ultimately sold it for, isn't it? Because I finally am able to do what? I'm finally able to take those amounts out of other comprehensive income and put them into net income. Okay. So if you're struggling a little bit, guys, you might want to go back to chapter 1, okay, and look back at our discussion that we recorded on how to handle unrealized holding gains and losses, right? And how, well, I gave you the example of unrealized holding gains and losses. We were talking in general, though, about what? Other comprehensive income, right? So this is not our first brush with this. Question?
Never mind.
Well, what? I mean, it's not like I'm, I'm not going to be visiting you as a ghost at some point. I mean,
I just realized. I just think, why make it so complicated? Is that unrealized loss and gain? We can just when we sell the stock, then we just realize the gain and loss. Why do we do all these steps? But that's my comment. Yeah.
Well, because FASB looked at securities that the company doesn't know if they're going to treat it as held to maturity, and they're not trading it on a daily basis. So FASB, remember, has to measure the benefits to the users versus the benefits, the needs of the preparers, right? So they looked at that and said, well, a fair way to kind of divide the baby, if you will, okay, is to say, well, look, we're not going to make you take it to the net income, but we want you to reflect somehow these changes in fair value, because there is a chance that you're going to sell that before maturity, right? So what we're going to do is have you show net income and show how those things would have what? Affected net income had you treated them as a net income item. That's the concept of OCI here. So then we're burdened with this part. If we accomplish that, yeah, once you sell it, then you got to take that step, reclass it out of other comprehensive income and put it into what? Put it into income, okay? But from a CPA exam standpoint, which is why we're here, I'm having you flashcard that any unrealized gain or loss, the realized gain or loss reported on available for sale security is the difference between the selling price and the original cost. So if you get a question and they give you all this other stuff as how it had moved around in the interim, who gives a shit? I don't care what it did in the interim. I know that the realized gain or loss, the question asked me that, is the difference between whatever I paid for it and what I ultimately sold it for. Don't forget that. That's something that saves you time on the exam while your counterparts are squirming around considering all kinds of other nonsense that's probably not relevant to the question. Okay, good. Come over and let's look at investment in equity securities now. Okay, and we're going to talk about two methods, either the fair value through net income method, which is what we're going to look at first here in a couple seconds right now. And then we'll look at the equity method. We'll probably take a little break and look at the equity method. Now, fair value through net income, guys, just picture in your mind, even though they don't call it that, it's the same treatment that we've been saying for trading securities. Just put that in your head. You don't call it trading because you don't put it in that category, because our stocks are either fair value through net income or equity method, unless we opt out of the equity method, because we can't do that, right? But it's really the same thing that you do for the trading. Okay, so let's just take a look. Equity securities are generally carried at fair value through net income. This requirement does not apply to investments carried under the equity method unless the entity chose the fair value method for the equity method, which they could. And then it does not apply to consolidated investees. There you don't have the option, right, of accounting for that under the fair value option. They don't let you do that if you have to consolidate. Okay. Okay, good. Now let's just go ahead and flashcard that you use fair value through net income, because let's face it, nobody wakes up in the morning and says, oh, let's use the fair value through net income method, right? I mean, it's kind of a funky, wordy name. So make sure you know that that's what they're talking about. You know that that's what they're talking about when they give you that kind of FASB speak, fair value through net income method, okay? But all it means is that you will mark the security to fair value, and unrealized holding gains and losses get reported on the income statement. They get reported on the income statement as they occur. They are included in net income. Okay, so flashcard that. And then if there is dividend income from this, that will be reported in net income as well. So you have two income streams for your equity securities accounted for under the fair value through net income method. You have what? You have unrealized holding gains and losses, could be a loss. And then if the entity pays dividends, then what? Then that's part of the income calculation as well, right? So if the question asks you what's the income, and they give you information about a dividend and they give you information about changes in fair value, you have to consider both of those. Now, there is, and you can see the journal entry for a normal dividend, which is simply debit cash, credit the dividend income. But there could be something called a liquidating dividend, okay? And if the situation occurs that the dividend exceeds the investee, the company's share of the retained earnings, that difference, the difference will actually reduce the investment account, because they're considering that as though it is a distribution of a return, if you will, of your original investment. Okay, so flashcard that, but let's just go ahead and let's just take a look at this example. I think you'll see this is pretty easy. So corporation sitting here and it owns 10% interest in XYZ Corporation. ABC owns XYZ 10%. During the current year, XYZ paid a total dividend of 10 million. XYZ had total retained earnings of 8 million when the dividend was declared. ABC received 1 million. That's the $10 million dividend times 10%. And will record dividend income for 800,000. That's what, 10% of the retained earnings. The amount that was distributed as a dividend in excess of the retained earnings, well, that's going to be treated as though it was a return of the investment. So we literally would sit there and do what? Credit the investment account. Of course, we have to debit the cash for the full 1 million. And the 800,000, excuse me, is what gets reported as the dividend income on the income statement. They call that a liquidating dividend. Okay. Okay, now you come over and let's take a look at the sale, not sale to security. Let's come over and look at required disclosures, okay? And I almost always have you flashcard disclosures, okay? So the required disclosures that you can see here is the aggregate fair value. You know, for some things, even though we're carrying them at amortized cost, FASB still says, hey, disclose the fair value. Okay, so you would have to disclose the fair value, unrealized holding gains and losses, amortized cost basis, and information about contractual maturities. Okay, flashcard that, guys. I mean, you know, in case somebody asks you a question, the exam asks you what needs to be disclosed. Okay, coming down, fair value, all public entities, public and private entities must disclose on the balance sheet or in the notes to financial statements all financial assets grouped by category, fair value through net income, other comprehensive income, or amortized cost. And if it's a financial asset, the form of that asset. So again, disclosures, just flashcard. Okay, now what I want to do, because they have this kind of comprehensive example here, and I don't like it because it starts to boggle the mind. I'd rather keep the example simple because I don't see any reason, maybe to Serena's point, in overcomplicating what we're learning here, okay, at this stage. And so what I want to do is, rather than, you know, kind of go through all that machinations there that are in that example, I think we were better off just coming over here and looking at the little example with much smaller numbers and not all this back and forth that they do in this example. I think is going to be much easier for us. Okay, so let's just look at this example that I kind of put up on eLearn. And company purchase available for sale security in year 1 for $24. Okay, $24. So I'm going to just go ahead and I'm going to set up my security, available for sale security, and I'm going to debit it for 24 when I bought it. Okay. Now, at the end of year 3, I say that the available for sale security had a market value of $3. So what do? I debit the available for sale security for $3. Now it's being carried at 27, right? And I credit unrealized OCI gain. And then I'm going to do what? I'm going to eventually close that to accumulated other comprehensive income. This gets reported on my comprehensive income statement, but I need to close it like I do all income accounts, but I don't close it to retained earnings. I close it to what? I close it to accumulated OCI, right? Is this like the retained earnings of other comprehensive income? Okay. Then at the, excuse me, thought I heard noise or something. Okay. Then what? Then I come down and, okay, what is all this? Okay, then I come down and at the end of year 2, the AFS security is valued at what? At 28 and is sold for 30 in year 3. So at the end of year 2, I would have done what? I would have debited the available for sale security for what? For another $1. And I would have credited the unrealized gain, which I then would have closed to my accumulated other comprehensive income for $1. And then I say, finally, in year 3, they sell it for what? They sell it for 30, right? Okay, so what happens when I sell it for 30? I will, of course, debit my cash for 30. I go ahead and I credit this security and I credit it for what? And I'm assuming that at that point, it was being carried at the 28, the 24 plus the 3 plus the 1, right? So I credit that. I need to debit my what? Debit my unrealized gain for 4, and then that will get closed out to my accumulated other comprehensive income. So it comes out of there. And I credit realized gain, and that is reported what? On the income statement, the 6. And guys, it's ultimately the 6 is the difference between what I bought it for and what I sold it for, isn't it? I bought it for 24 and I sold it for 30. That's always what ends up on the income statement eventually. Okay. Question? Okay, good. Then let's go ahead and let's turn our attention to our first multiple choice questions of the evening here. Coming down, oops, here. I'm not going to go through that example because they just keep giving you different securities and all these different, situations. I think the main takeaway that you want on how to handle those is how to deal with the available for sale security when you ultimately sell it. Okay, all right, good. So let's just go back to full screen. And I'm going to go ahead and put the poll up. Okay, guys, I think that's enough time for this question. Looks like, well, everyone got it right until the last person came in and chose the wrong answer. No, if it's a trading security, fair value and withholding gains and losses included in earnings, I can't tell you why C is wrong other than it's wrong. That's not how you do it for a trading security. So I'm not sure why somebody picked that. So I think we did pretty good on that one. Okay, trading security, right? Okay, good. I have a feeling somebody got scared when I said, okay, they were probably checking their text messages and then they decided to go ahead and choose one. Okay. Okay, good. Let's go ahead and let's take a look at this one. Question number 2. Okay, I'll give you 30 more seconds, guys. Okay, we're at about 3 minutes now. So I'm going to go ahead and end the poll so you should make your choice. And good, this is good result. Almost everybody got this correct. It's not the easiest question in the world. It is one, however, that I think you will get very good at. The type of question you'll get very good at on the exam, and you shouldn't really not take more than 2 minutes to answer a question like this, even though I gave you a full 3 minutes. Okay, but let's just take a look at this, and they tell us that they did what? Information available for their marketable securities is that they had purchased them for 170,000. They give me the market value at the end of year 2. Now they say that at December 31st, year 1, they had reported an unrealized loss of 1,500 to reduce these to market value in year 1. Now, if we consider the available for sale security account at that point, originally we had what? Cost of 170,000. We did what? We credited it for 1,500. We of course would have debited what? Accumulated comprehensive income. That would have been closed to accumulated. We would have debited OCI, and then we would have closed that to accumulated other comprehensive income for 1,500. And so at this point, the balance in this AFS at the end of year 1 is what? 168,500. Then when they get to year 2, they tell us what? Well, now the thing's down to 148. Okay, so they say that in its year 2 statement of comprehensive income, what amount should be the unrealized loss? Well, now it's already down to what? 168,500. And we need to bring it down to what? To 148, don't we? That's what we want to show as the balance. Okay, 148,000. So if that's the case, the difference between what? The 148,000 and the 168,500 is an additional 20,500. So what would we do? We would go ahead and credit the security now 20,500, debit the other comprehensive income, and close that to what? 20,500. Okay, so in year 2, we would take that 20,500. Now, if the question asks me what is the amount that should be shown in accumulated other comprehensive income, then the answer would have been what? Choice C, right? But here they just simply wanted to know what was taken on the statement of comprehensive income for year 2. It's just the difference between the carrying value at the start of year 2 and the carrying value at the end of year 2. Okay. Okay, good. Let's take a look at question number 3. Okay, guys, let's go ahead and excuse me, take a look at this one. I'm going to end the poll. And again, we're just about everybody's getting these right. So that's good. We're at 90%. For this one, they were talking about essentially the liquidating dividend, although they didn't call it that. Okay, but let's take a look at this one if I can find my cursor here. Okay, an investor uses fair value through net income to account for investment in common stock. Dividends received this year exceed the investor's share of investees' undistributed earnings since the date of the investment. Undistributed earnings is a fancy way of saying what? Retained earnings, right? Okay, so our share of the retained earnings is, say, 800,000. They pay us a dividend of $1 million. Just borrowing from that example we looked at. So what happened? 800,000 of that gets reported where? On the income statement. 200,000 of that million is going to be what? Reduction to the investment account. Just to go back to that example that we had earlier. So the portion of dividends that would be reported in the income statement this year would be the portion of dividends received this year that were not in excess of the investor's share of the investees' undistributed retained earnings, which again is their undistributed earnings, which is the retained earnings since the date of the investment. Okay. A, which I think somebody picked, is actually the opposite of what you're supposed to do, right? Okay, we're going to go ahead and we are going to take a break and we're going to come back and work our way through module 2, the equity method. So I'm showing, we'll go ahead and we'll just come back at 7:05, okay? I'm going to pause the recording. Somebody please remind me to start. Okay, good. So now, of course, after the break, we are still talking about how to account for equity securities, essentially stocks. We've seen the fair value through net income method. And now we're going to look at the equity method. They tell us that the equity method is to be used when we can exert significant influence over the investee. Now, how do they determine significant influence? And they tell us that significant influence happens when we own more than 20% or more of the stock, but not more than 50% of the stock. Okay, now if we own 50% of the stock, more than 50%, right? Then we should consolidate and we're not going to use the equity method anymore because we have now gone over the 50% threshold. We're considered one company, and that's what we'll start to talk about next time when we get into module 4. So if we're at 19.999999999%, we're using fair value through net income. You cross over to 20%. You use what? You use the equity method. You go what? 50.00001%. You start consolidating. Okay. Now, they tell us under that situation, when you get in that 20 to 50%, they say we must use the equity method. Of course, they're ignoring the option, the fair value option that we talked about earlier with that sort of strong statement. Okay, so you can go ahead and flashcard that 20 to 50% rule if you feel you need to, although I think it's pretty easy to remember. Okay, now when you come down to what I definitely want you to flashcard and find, there's a helpful passkey here. They tell us that the CPA exam frequently presents a question in which the ownership percentage is below 20%, but we still have the ability to exercise significant influence. Then the equity method would still be appropriate. For example, we own, say, 18% of the stock, but nobody else owns more than 2% of the stock. Well, as the major stockholder, we would then be considered to exert significant influence. So you need to read the question carefully just don't, sort of memorize that 20% rule and then not read the question carefully to say there are no shareholders that own, more than 2% of the stock, let's say, then we would still use the equity method, even though we're below the 20% threshold. And then that goes the opposite way. We could be holding, 20% or more of the stock, but we will not use the equity method if the entity is in bankruptcy, the investment is considered temporary, there's some sort of lawsuit or standstill agreement, or there is another small group that has a majority ownership. For example, maybe we own 20%, but somebody else owns what? Somebody else owns 40%, then we can't exert significant influence and we would not use the equity method. We'd be back to the fair value through net income method. Okay, so flashcard those scenarios. Now, when we look at the equity, you can continue on with the flashcard to the next page. Just go ahead, and I'm not going to call those out. Just flashcard situations in which, even though you're at 20% or more, you would not use the equity method because you'd be considered not having significant influence. Okay, now the mechanics of the equity method, I think you're going to see, are pretty easy. Some people might even call them kind of fun. Okay, so what happens when you look at the equity method? You will go ahead and, of course, you will make the investment. Okay, so you'll debit the investment, you'll credit the cash, whatever. Then what you will do is the problem will tell you what is the net income of the investee. You will take your share of the income of the investee. So if you own 25% of the stock and they tell you that the net income of the investee was 100,000, you would credit earnings on investee income and debit the investee account. Now, the investee investment, right, is reported on the balance sheet. This equity and earnings is reported where? On the income statement is your income from investment. Now, what the problems will also do is they'll tell you, well, there is a dividend that is paid. They'll probably give you the whole dividend that was paid out. The portion that would be attributable to the company that's investing under the equity method would be what? The percentage of the entire dividend times whatever percentage of the stock that they own that's given in the problem. So if the income was, 10,000 and you own what? 25% of the stock, you would debit cash, 2,500, credit investment and investee. That is obviously cash is on the balance sheet, investment investee is also on the balance sheet. Okay, now let's just go ahead and let's look at this numeric example, and then I'm going to come back and have you flashcard that passkey. But let's just look at this numeric example here, and we acquired 40% interest in a small company for $300,000. Now you look at that, and there's nothing else in this fact pattern that's going to say that you shouldn't use the equity method. So we're going to use the equity method. When we buy the investment, we're going to debit the investment for $300,000. We're going to credit the cash, right? Okay. Then what? Then they tell us, coming back up to the fact pattern, that the assets during year one, small company had net income of 90 and dividends of 40,000. So we're going to do what? We're going to debit the investment account, 36,000, right? We're going to credit the equity and investee income. That shows where? That shows on the income statement, right? Okay, and of course the investee account, the asset for the investment is shown on the balance sheet. And then when they pay a dividend, right, and they tell us in the fact pattern was a $40,000 dividend, which we get 40%, we debit the cash, we credit the investment for 16. Okay. Now, what questions will often ask you is at December 31st, what should we be showing on the balance sheet for the investment account? And the answer would be the beginning 300,000 plus the 36 minus the 16,000 we took out for the dividend. Thus, this pass key up here that you should flashcard, okay, and it's the BASE mnemonic. You go ahead, you start with whatever the balance was at the beginning. You add our share of the net income. So we had 300,000. Then we had what? We had our share of the income, which was, refresh my memory here, 36,000. Then we did what? Then we subtracted our share of the dividend, which was what, 16,000, I think, right? Am I remembering that correctly? Short-term memory loss here, okay. And then we ended up, what was it? The ending balance was 320. Okay. Okay, not bad, kind of fun. Doesn't bother me too much. I kind of like the equity method. Okay. Now, what happens if I'm sitting here and I have both investment in common stock and preferred stock? Sometimes problems will do that, okay? Well, first off, the significant influence test is only warranted on the common stock because preferred stock typically does not have the ability to vote, right? Okay. The calculation of income from the subsidiary is going to be the combination of the preferred dividends, whatever they would probably give you in that problem, and our share of the income available to the common shareholders. The income available to common shareholders is going to be the net income minus the preferred dividend. Okay, so let's just go ahead and look at the class question number 2 here. Okay, if you want to, you could almost kind of point down from there to question 2. Okay, and let's go ahead. Yeah, let's do it together. Why not? Okay, so what happens? You take a look at this question. They tell us Moss Corp owns 20% of Dubro Corp's preferred stock and 40% of the common stock. So we're going to use what? We're going to use the equity method because we're well past the 20% threshold for the common stock, right? The 10% cumulative stock is total 100,000, and the common stock has a total of 700,000, which really isn't relevant to this question. Durbo reported net income of 60 and paid dividends of 10 to his preferred shareholders, and they want to know how much revenue we should take on this. Now, the first thing I would figure out if I'm looking at this problem is how much income is available to the common shareholders. So I would take the 60,000 net income, but I got to back out what? The 10,000 for the preferred dividend. So that means there's only what? 50,000 that is available to the common shareholders. Then I take that 50,000, and since I own what? 40%, I would, under the equity method, show investment income of 50,000 times 40%, or what? 20,000. Now notice they gave me 20,000 as a choice, but that's not the answer because now I have to consider what? The preferred dividend. And so I take that 20,000, I'm just going to write it again over here. We had what? Preferred dividend of 10,000, but we don't take the whole thing because we only own what? We only own 20% of that $10,000 preferred dividend. And so 20% times the 0.2 here means that we got another 2,000 coming to us for our preferred dividend. We take that and we have the total of 22,000. So the correct answer here is A. Question? Okay, good. Let's go ahead then and what wasn't that a movie? Let me let you, was it? Help me help you. Go ahead and you can do this next question on your own. Okay. Okay, guys, we're coming up on 3 minutes. I'm going to go ahead and end the poll. I would think a question like this you would probably be able to do in less than 2 minutes once you get a little more practice with these. But good. For the folks who were able to get through this one, we got a good 100%. So that's great. Okay, but let's just go ahead and look at it together. And really, the tricky thing here with this question is that what we're below the 20%, right? But they told us, I'm going to move that poll out of the way. But they told us that we are the single largest shareholder. We have people on the board of directors. So they're trying to tell you exert significant influence, right? Okay. In fact, I'm surprised that they didn't give us a choice that just contemplated the dividend to try to trick us to see if we just memorize the 20%. But this question was not that evil. Okay. So what happens if we bought the investment for 400,000? And then the entity had net income, the investee had net income of 500,000. And notice we use the 10%, even though, you're saying, well, gee, we didn't have 20%. So we can only use the what? The 10%, 50,000. Okay. Not sure why that's moving in slow motion. And then what? And then we had this dividend of 150. So 150,000, right, times the 0.10 means that we have to subtract that 15,000. And so that gives us the correct answer. What is it? 435,000. Choice B. And everybody got that. Okay. Okay, good. Let's take a look now at the next section here and what happens. The entity is reporting, things at what? At book value. If we're talking about, say, property, plant, equipment, they're supposed to be doing what? They're supposed to be carrying that at historical cost, aren't they? Okay. But if we come in and we acquire 20% or more of the stock, and thus we're now moving towards the equity method, what they're going to say to us is, well, really, you have acquired those assets in an arm's length transaction. So we're going to write those assets up to fair value. So some of the purchase price would have to be allocated to the fair value of the assets, the difference between whatever the investee was carrying them at and what their fair value was at the date that we have acquired enough stock to warrant the equity method. Now, if we still pay an amount over and above our share of the fair value of the assets, that difference would be considered goodwill. Now, when you are below 50% or less, you're not going to consolidate. Listen to me, guys. That goodwill does not get reported anywhere. Goodwill only gets brought onto what? Onto the consolidated financial statements. Okay, so be careful with questions. If they tell you what is the amount of goodwill that should be reported, the answer is what? Unless we're consolidating, the answer is 0. If the question asks you what is the amount of goodwill attributed to the transaction, what is the amount of goodwill implied, then yes, you would calculate that goodwill as the difference between the acquisition price and the fair value of the asset. So you got to be careful when you read those questions. Okay. Okay, good. So go ahead and flashcard here. And for this goodwill, just say not reported if no consolidation. In other words, we're holding less than 50% of the stock, and therefore 50% or less of the stock, and therefore we're using the equity method, because if we go over the 50% threshold, we'll be consolidated. Okay. All right. So let's just go ahead and let's take a look at this we don't need all this nonsense. Let's just take a look at what happens for the excess fair value. The excess of assets fair value over book value is amortized over the less of the asset unless the excess is attributed to land, because we don't depreciate land. Okay. But if the excess is attributable to an amortizable or depreciable asset, we are literally going to do what? We are literally going to reduce the amount of income we've taken. Think of it. It's like there's excess depreciation that wasn't reported in the net income of the investee. But if we were now looking, saying, well, those assets had a higher fair value, then our portion of the income is going to be reduced by the additional amortization depreciation that was taken on that asset. And again, it doesn't happen with land. Okay, so let's just look again at a numerical example. Okay, and they tell us that on January 1st, year one, big corporation acquired 40% of an interest in small company for $300,000. Okay, fine. Debit the investment, credit cash. Okay, so let's just go ahead and we could see that the investment account here has what? Has $300,000 got debit. Okay, they report $90,000 of net income. Okay, great. So we're going to take 40% of that, $36,000. That gets debited into the investment account. Equity investee income, that's reported where? On the income statement, right? Then what? Then there was the dividend of $40,000. Again, I'm not reading from the question here. I'm just remembering what we talked about before, right? Debit cash, credit the investment. We've already looked at this fact pattern for that information, okay? Now what happens? Now they say, they give us additional information. They say at the date of the acquisition, small company's assets had a book value of $550 and a fair value of $600,000. The difference between the book value and the fair value of the asset is equipment being depreciated with a remaining useful life of 10 years. So I look at that and they tell me that I acquired what? Assets that had a book value of $550 and a fair value of $640. So I'm looking at that and I'm going to say, okay, I had something that had a fair value of $600,000 and I acquired what? 40% of that. So I got something worth what? $240,000. Okay. And they sit there and they tell me that what? I acquired at book value $550. Right? The book value was $550. I acquired that at 40% of that. So $550 now times this 40% is going to be 220, right? So that means, I think I put an extra zero. That means that what? There was a $20,000 difference between the book value of the assets and the fair value of the assets that I acquired. Well, I have to amortize that difference because they tell me that that 20,000 was for an asset that was being depreciated over what? 10 years. So I divide that by the 10 years. And that gives me a difference of what? A difference of $2,000. So I would take that $2,000, okay, and I kind of wrote the same calculations that I made over there were actually here, okay? And I go ahead and I do what? That's the 240, that's this, probably would have been better off to have written it over here. 600,000 times what? 0.4 was the fair value. What was it? 550 times 0.4 was the book value. That's at 20,000. That 20,000 divided by 10 means that I'm going to actually reduce the amount of income from that investment that I report on the income statement, and I will reduce the investment on the balance sheet for that 2,000. And so if the question was asking me what's the ending balance in the investment account, I'd have to know to reduce that, right, by the 2,000. I credit it for the 2,000. Now, the other thing that could have been asked out of this fact pattern is, what is the implied goodwill? What is the goodwill attributed to this? And for the equity method, when we start calculating the amount of goodwill to be reported on the balance sheet for consolidation, we can't do it this way. But for the equity method, when you're below 50%, you simply ask yourself, what did I pay? What did I get? What did I pay? What did I get? I paid what? I paid 300,000, and I got 40% of assets that had a fair value of 600,000, didn't I? So I got what? I got fair value of 240. Well, what's the difference? The difference is goodwill. There's some cloud floating around this company that is so wonderful that I'm willing to pay more than the fair value of the assets. That's called goodwill. Okay. Now that goodwill is what? Is not reported. There is no consolidation. There's no place to report that goodwill. It's not reported. However, sometimes the question will say, what's the goodwill attributed? What's the goodwill implied? Just know that if you're what? If you're at 50% or less, you're not using the equity method, so the goodwill is not reported, right? Okay, good. Now, if there is impairment of an asset under the equity method, what should we do? If the fair value, flashcard, if the fair value of the investment falls below the carrying amount and the entity believes the decline is other than temporary, if both conditions are met, the entity reports an impairment loss and the carrying value of the investment is reduced to the lower fair value, and the impairment loss is not permitted to be reversed under US GAAP, which we only test US GAAP on the CPA exam. So let's just look at this, and this is worth looking at. Okay, we have this precious metals, and we acquired 25%, and the investment was being recorded a carrying value of 5 million. GEMS reported net loss of 80, paid no dividends, and we estimate that the investment had a value of 4 million due to a permanent closure, etc. Okay. Now, what happens? Notice we have the beginning balance. We have to take our portion, and if it's a loss that we're taking a portion of, that's reducing the value of the investment, right? We would debit the loss from investment that gets reported on the income statement. We would credit the investment. So now the investment has a book value of 498. They told us the fair value is 4, so we would take an impairment loss of 980. Okay, good. Let's go ahead and let's take a look at a couple more questions, and then we'll probably get out a little bit early because I don't want to get into the consolidation process the little bit of time we have left. So, but let's go ahead and take a look at a couple questions. Okay, guys, let's go ahead and take a look at this one. We're a little over 2 minutes. Most of us got this right. There was one person that picked C, and I noticed that sometimes when a question is confusing, folks default to C. Don't do that on the exam. Okay, anyone who told you when in doubt choose C is a fool. Okay, if you get on the exam and you don't have any idea as to what the right answer is, try to think back in your mind and say, have I picked a lot of A's already, a lot of B's already, and pick whatever letter you feel you haven't picked that much at that point in time, okay? Because the examiners distribute the choices evenly between A, B, C, and D, so there is no, well, C. If you're taking a test in college, yeah, because maybe the professor wrote the questions and they know the right answer is A. And by the time they get to, you know, C, or they're writing wrong answers and they get tired of writing wrong answers, and then finally they put C as the right answer, then they only have to come up with one more wrong answer. But that's not the way the exam does it. They shuffle the choices between A, B, C, and D. Okay. Now, in this question, which most of us got it right, the answer is B. Okay. Part company uses the equity method to account for its January 1st year purchase of Ton Inc.'s common stock on January 1st. Year one, the fair value of Ton's FIFO inventory and land exceeded the carrying amounts. And so how should the excess of fair values over carrying amount affect the reported equity in the subsidiary Ton's year one's earnings? Now, first of all, land is not depreciated, right? So the fact that some of that, would have been attributed to land has what? Has no effect. So we're immediately getting rid of what? Getting rid of A and C. That's my point about don't just pick C. Look to see if you can eliminate C if you're confused, right? The depreciation, there is no depreciation on land. But for the inventory, okay, remember we have what? We have the beginning balance of inventory, okay? And we're saying that what? We would have written up the beginning value of that inventory for that higher fair value, wouldn't we? Okay. Then whatever the purchases were during the year would give us what? Goods available for sale that is now going to be higher because we wrote up the beginning inventory. They're using FIFO, so the beginning inventory would have been sold, right? Okay, so what happens? We would go ahead and subtract the ending inventory, which is going to be reported at these year-end prices now. The ending inventory now, right under the FIFO method, is going to be whatever the fair values are, because remember, FIFO kind of tends to report the on the balance sheet the inventory at fair value because it's the things that we just bought that are still sitting in inventory. Remember the milk example. And so our cost of goods sold is going to be what? Our cost of goods sold then will be overstated, and therefore our net income, not overstated, but will be higher. So our net income will be what? Will be lower. So it'll decrease my net income. Okay. Okay, good. Let's take a look at number 4. Okay, most of us have had a chance to try this one, and looks like we got a pretty good percentage coming here. So I'm going to go ahead and stop the poll and share the results. Looks like everybody got it right. And again, with questions like this, when they ask the goodwill that is attributed to the acquisition, now they didn't say reported. They said reported, the answer is 0, right? But they're saying what's the implied goodwill, the goodwill that could be attributed to the transaction, and you're dealing with the equity method because I'm less than 30, I'm less than 50, from 50% or less. So I'm using 30%. So I know I have to use the equity method. And the question becomes, what did you pay? What did you get? Okay. And they tell me that what? They tell me that December 31st, they paid what? 200,000. And for $200,000, they got 30% of assets that had a fair value of what? 600,000. So I take that 600,000 times the 0.3, that's 180,000. Well, if the assets have a fair value of 180, why the hell did I pay 200,000? There must be what? There must be goodwill here of 20,000, which everybody got. Okay. Okay, good. Let's go ahead and try this last question, and then we're going to call it. Well, I'm going to give you some instructions of what I want you to do with the next module, and then we're going to get out. But let's just take a look at this. Okay, guys, we're coming up on 3 minutes, so I want to go ahead and end the poll. And we had a pretty good outcome, even though we didn't get up to the 75%. I can see why maybe some of you would have picked D. So we're getting there. Okay, so this is almost, you know, short of 100% outcome. This is about the best I would, you know, the next best situation that could have happened here. Okay, so let's just understand why it was B and not D. Okay, so when I look at this question, okay, they tell me that Puff acquired 40% of Straw Inc.'s voting stock for $400,000. Okay, now, so I know that they would have debited cash, right? And they would have, I mean, did I say debited cash? They would have credited cash and debited the investment for $400,000, right? Okay. Then the carrying amount of Straw assets totaled $900,000, which equaled fair value for all items except equipment, for which fair values exceeded carrying amount by $100,000. Now, you didn't need to do this for this question, but my sense when I looked at this, I'm like, okay, 400,000 is what they paid. You multiply that 400,000, that 400,000 should be equal to what? Should be equal to 40% of what? Of the 900,000, the book value, plus what? Plus the 100,000. So it should be what and I want to figure out what the fair value is of everything here. So I could sit there and I could look at that and say, well, the fair value, right, would be 400,000 divided by 0.4, or the fair value equals what? Equals $1 million. So it's correct. The fair value of everything I acquired was $1 million. And then they tell me that that was what? Accounted for by 100,000 of assets that had a fair value in excess of their book value. And then they tell me that those assets there was equipment that had a 5-year life. So I take that 100,000 and I divide that by what? By 5. That means I have extra depreciation here of, am I doing that right? Why does that not sound right now? Extra 100,000 divided by 5 is supposed to be, is 20,000. But I only own what? I only own 40% of that. So I multiply that by 0.4. That gives me what? 8,000. Okay. And then they want what should be reported on the income statement. Okay. So if I had what? I had 150,000 of income. I would have multiplied that by 0.4. And for the income, I'll put it down here. I would have what? Credited income 60,000 and debited the investment 60,000. But then I have to take my share of the excess depreciation. So I would have debited income 8,000 and credited the investment 8,000. And I'm showing you the investment because the question could ask you what's the balance in the investment account, right? At the end of this, and you end up with this 52,000, right? Okay, so I did this little thing just to make sure, in my mind, being an accountant, am I fully understanding what's happening here? Oh yeah, it was fair value of $1 million, and then they told me that what? That extra 100,000 was all attributed to the that piece of equipment, of which I only owned what? 40% of that. So I only took 40% of the depreciation. Okay. Okay, you come over and you don't need that. Transition to the equity method. Okay, what happens if I have, say, 10% of the stock, and then in the next year I acquire an additional what? An additional 15% of the stock. Well, now I've gone from the fair value to net income method to what? Using the equity method. Okay, so if that's the case, when significant influence is acquired, it is necessary to record a change from the fair value through net income method to the equity method, add the cost of acquiring the additional shares to the investment account, debit the investment, credit the cash for whatever I paid, adopt the equity method at that date and go forward. There is no retroactive treatment. So this is not treated as a change in accounting principle because the standards told us we don't have to. If you have a new FASB and the standards tell you you don't have to treat that as a cumulative effect change in accounting principle, then you don't have to. You use the new method prospectively. Okay, so that's what happened on January 1st. They paid $15,000 for 15%. Then they went ahead and they bought some more, and that brought them to a total of 45% by paying $60,000. You simply debit the investment for the additional amount, credit the cash, and now you start using the equity method going forward. They used to make me calculate a cumulative effect adjustment. It was ridiculous. And so you should be thankful that they got rid of that. Is there a question? Okay, now for module 3, guys, I want you to watch the pre-recorded lecture that Becker has for you. Please watch that so that we can hit the ground running. It goes through some basic definition things that I think we're better off if you spend time with that on your own. So as part of your homework this week, you should be wrapping up chapter 3, getting through the first 3 modules of chapter 4, which is going to require you to watch the video for some of this module 3 stuff. It's not a lot, okay? Because I want us to be able to come in on next Tuesday when I will be in class. So folks that want to come pick up their books can do that at that time. If you're not going to come pick up your book, I will be mailing it out to you. So send me your address. That's for folks, only the folks that told me they need the book should be sending me that email. Okay, because I got enough books for those folks that alerted me that they wanted to get 4.2 because they already ordered 4.1. And then we will hit the ground running with module 4 on Tuesday. Question?
I just thought of a question when we were talking about the differences between purchase price and book value of investees' net assets.
Mm-hmm.
That's only when there's an excess, not when there's like carrying amount is over fair value. Just wanted to confirm that.
Well, the question would have to tell you if they acquire amounts over the book value, that it's attributable to a depreciable asset for you to have to do that. And they'd have to essentially give you the life of the depreciable asset to calculate the difference, the reduction of the investment income. In that other problem we looked at, they didn't call out any of the difference between fair and book value being attributable to any assets. So we applied it all to goodwill, right?
Mm-hmm.
So first, any amount you pay over book value go to the fair value of first tangible assets, then specifically identifiable intangible assets, and then any amount that's still left over is considered the goodwill. But if the question doesn't start talking about the write-up of any assets, then it becomes fairly straightforward. What you pay, what you got. The difference between the fair value of the assets and what you paid is the goodwill.
Okay, thank you.
Mm-hmm. So in that problem, the only reason, Michael, I did it because I like to do that because I want to make sure they're not trying to sneak a curveball past me, that maybe there was some goodwill in there. So I looked at it and said, yeah, they paid $400,000 for 40% of the company. That means the company's worth $1 million. And then they told me the book value was of the identifiable assets was 9, except for one asset equipment, which was 100,000 more. So it kind of reconciled for me. So that I just I did that just to make sure, am I amortizing the right amount, that 100,000?
Okay, that makes sense. Thank you.
Okay, guys. That's it for tonight. I will see you. Some of you, I'll see you in person on Tuesday, and others will see you on Zoom. Okay.
Thank you.
Thank you. Have a good night.
Good night, guys.
Bye.